The stock market is currently closed, with official regular session trading for the Trade Desk Inc. closing on August 6, 2026 at $17.67, representing a single-day drop of 6.8%, followed by severe post-market pressure dropping the stock toward $13.37. Most market observers assumed that demand-side advertising platforms would easily absorb the broader shifts in corporate marketing budgets, believing that automated data-driven buying would act as a bulletproof hedge against softening economic trends. The reality hitting Wall Street right now tells a completely different story. While retail investors were busy tracking mega-cap movements like Tesla stock, Apple stock, and Nvidia stock on their favorite mobile platforms, a quiet structural shift in digital ad pricing was taking place directly under the surface. When you log into your individual brokerage or check your watch list on the Robinhood app, the immediate narrative around ad tech seems straightforward. Conventional wisdom suggests that as legacy television loses viewers to streaming services, ad spend naturally migrates toward demand-side platforms. Investors utilizing Schwab Intelligent Portfolios or building self-managed accounts through Interactive Brokers stock trading often treat ad software giants as recurring revenue cash engines. The common consensus was that companies enabling programmatic buying would maintain double-digit top-line growth regardless of quarter-to-quarter volatility. But challenging that belief reveals a tougher truth. The trade desk is not immune to the macro pressures forcing brand managers to tighten their belts, and relying solely on industry expansion without accounting for severe margin pressure or revenue growth decelerations is a major mistake. Looking at the immediate trading volume and daily market swings, the pressure on the stock has been relentless. In recent trading sessions, heavy institutional selling pushed trading volume past 92 million shares, vastly exceeding the typical daily average. Wall Street responded aggressively after second quarter revenue came in at $715 million against analyst expectations of over $751 million. When a high-multiple growth company misses revenue targets by that wide of a margin, institutional algorithms liquidate positions fast. Whether investors are looking at their portfolios through Fidelity Wealth Management, monitoring positions on SoFi Invest, or reviewing holdings inside Fidelity IRAs, seeing a stock drop from its 52-week high of $91.45 down to the mid-teens creates a massive divide between market expectations and fundamental reality. Traders using Interactive Brokers platform and those using Robinhood stock trading saw intraday volatility escalate dramatically as short-term traders scrambled to hedge their exposure. Options volume surged and the implied volatility spiked as analysts across major firms rushed to downgrade their price targets. Retail traders engaged in self-investing through platforms like SoFi Active Investing often react to headline numbers, but institutional order flow shows a deeper repricing process. The stock had traded with high valuation multiples for years, meaning market participants treated it as the undisputed leader in independent programmatic buying. When growth rates decelerate, that valuation premium gets erased rapidly. Macroeconomic pressures have forced advertisers to trim discretionary spending, delay campaign commitments, and negotiate harder on take rates. When corporations review their balance sheets, digital advertising remains one of the fastest line items to pull back. While retail accounts managed via Fidelity Brokerage or SoFi Robo-Advisor automatically rebalance during sector rotations, active traders using the Fidelity trading platform are witnessing a classic valuation reset. The market had priced in flawless execution for years, meaning any minor slip in guidance or quarterly execution would trigger severe downside repricing. To understand why this gap between expectation and reality exists, we need to examine what the business actually does and how its economic engine functions. Founded as an independent demand-side platform, the company provides software that enables ad agencies and brands to purchase digital advertising campaigns programmatically. Instead of negotiating directly with individual websites or television networks, buyers use the company's technology to run targeted ads across connected television, video, display, audio, and mobile channels in real time. Their business model relies on charging a percentage of the total ad spend passing through their software interface. The core value proposition centers on transparency, offering an independent marketplace that does not own media content, which theoretically avoids the conflict of interest inherent in walled garden ecosystems operated by social media behemoths and search giants. Over past years, historical reports documented stellar top-line growth, high operating margins, and impressive customer retention rates exceeding 95%, which established its reputation as a premier growth asset for long-term online investment strategies. However, historical performance does not guarantee future stability when structural changes take hold. Connected television was supposed to be the ultimate growth driver, yet streaming platforms have increasingly built out their own internal ad sales infrastructure or partnered directly with competing supply-side platforms to retain margin. Additionally, the industry-wide transition away from third-party tracking cookies has forced digital ad platforms to invest heavily in unified identity solutions. While the adoption of unified ID systems was designed to preserve targeting precision, the transition period has introduced friction, longer integration cycles, and increased capital expenditures. For retail investors researching investment help or comparing options on various investing sites, evaluating whether this sell-off presents a genuine value opportunity or a falling knife requires examining both potential upside catalysts and significant downside risks. On the bullish side of the equation, the long-term secular transition from linear broadcast television to connected streaming services remains intact. If corporate ad spending recovers heading into upcoming seasonal spending cycles, ad buyers could re-accelerate campaign budgets through independent software platforms. Furthermore, international expansion and deeper integration into retail media networks offer untapped revenue avenues that could restore revenue momentum over time. On the bearish side, intense competition from rival ad tech providers and walled gardens continues to exert fee pressure on platform take rates. If economic growth slows further, advertising budgets could remain constrained for multiple quarters, leading to additional downward earnings revisions. Valuation multiples that were once justified by 30% annual revenue growth become difficult to defend when growth drops into single digits or low double digits. Investors reviewing their holdings across Robinhood Investments, SoFi stocks, or Fidelity mutual funds must carefully weigh these execution risks against the current discounted share price. Comment below how many shares of the Trade Desk stock you currently hold in your portfolio, or tell me if you think programmatic ad spending will recover before the end of the year. Looking at the broader horizon, the tension between market expectation and operational reality defines the current thesis for the stock. Investors who expected seamless execution and uninterrupted revenue expansion have been forced to confront the harsh reality of cyclical advertising drawdowns and valuation compression. While the long-term secular thesis for programmatic advertising in connected television remains valid, the path forward requires realistic expectations regarding growth rates, profit margins, and competitive dynamics. Whether you manage your own account through an individual brokerage, use automated options like Schwab Intelligent Portfolios, or trade actively on the Interactive Brokers platform, navigating high-growth tech stocks demands looking past initial market narratives and focusing directly on underlying fundamental execution. The market has delivered a sharp reality check, and how the company navigates this challenging operating environment will determine its trajectory for years to come. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel. Love.